given that the branch banking was a major cost center earlier. Can we see that inflection point from now on, that the cost, the OpEx ratios will start moving down?
Yes, of course. You should expect that from us.
So any targets, because our guidance does not include any, in next 5 years, any cost side type of guidance, but anything you can outline for next 2-3 years?
See, by end of this year, we expect the cost income ratio to be roughly flattish for the next 2 quarters. And Q3 and Q4, we see meaningful reduction. So like Q4-ish, so clearly we feel we'll be in a strong wicket. The reason is actually simple to understand. As all of you know, our credit card business will start with moving to profitability by Q3, Q4, so we're bang on plan. If you remember, we had always said that by 25-ish, end-ish, it will start moving, and by 26, we'll make money. So that crucial inflection point is coming towards Q4 of this year. Did you put out product segment by segment cost income ratio? Yes. Can you show that screen to me? So for example, the credit card business, our cost income ratio in FY22 was 240%. In FY23, it's 164%. In FY24, it is 116%, a big drop. And by FY25, we expect it almost, sub 100%, it'll come below 100%. So this is one reason why we expect the Q4 to look very good. Similarly, our cost income ratio on retail, rural, and SME business is running at 55% now for 2 years at a stretch. So it could marginally come down, but it's stable at 55. Should come down, of course, in due course. Our wholesale banking is running stable at like 33%. So therefore, the only drag was liabilities. So coming to your, so therefore, just to conclude that point, we feel that at scale, our cost income ratio should start turning down, but material, let me say, in Q4, Q3, Q4.
Sure, sir. Second question was on basically a lot of discussions around tech and how things are happening in the industry. Just a small question was that you have some of the products where you have leadership in, for example, FASTag, you have significant UPI volumes. How are we geared up to handle these kind of volumes? Because these seems to be a niggling issue in the industry.
Actually, our bank, let me just say that we've been, nobody can ever be too sure, first of all. Okay, this is an area we always watch for, and, frankly, we can never be complacent. Let me say, we can never be too secure. We have, because we're conscious of the risks of that tech or not being invested in tech can play a role, we have been implementing, let me say, the latest technologies. Many of you call us a high-cost bank, and, you call us names. But I can just say that it's well spent, that I can assure you. So we have invested in the best CRM system, in the best ticketing system, in the latest versions of the middleware. Our applications, are let me say, the best of what India has to offer, because some of these things are, they're industry standards. So, applications are applications. We have built a really good engineering team. We do performance testing literally all the time of our engineering teams. We are building fantastic, I don't know if you, Pritesh, yourself have used it, or maybe anybody else who can speak on this forum, and over 210 people are here. I can almost tell you that any one of you would have experienced the bank, experienced us, not just known our brand name, experienced us. I would say that you would say really good things about our app. Our app is really becoming fantastic. I'm scared to use the word fantastic for ourselves, but let me just say good. Let me just say that probably our app is really good, and we're developing. Its response time is really very good. Our uptime is fantastic, really, on almost all lines of business. So we have, let me just say, we invested wisely in technology. And as I said earlier, it's not about the money we spend, it's about how we use them. So we really spend a lot of time right at my level, my one-down level. We don't take, we try not to take any chances. And if we find any issues, then we take it very seriously. If anyone else flags an issue to us, We really jump, up and down to figure out how to solve it in a quickest possible time. Our board is very engaged. Our board also is, even at my level, I understand technology. My subordinates understand technology. My two-down understands technology. Our board has a specialist of understand technology. We all put an effort after that.
Sir, got it, sir. Thank you so much. All the best.
Thank you. The next question comes from the line of Gao Jaishwam with Shontao. Please go ahead.
Good evening, sir, and thank you so much for the opportunity and congratulations. Just want to understand on the deposit front. We've been doing a fantastic job in terms of outgrowing everyone's deposits. But when I look at the deposit per branch, that has shown a pretty good growth of 14% in the fourth quarter, which is similar to that dropped 13% in the fourth quarter of last year. So I just want to understand how should we think about branch level deposit growth going forward. When do you think we will actually outgrow the industry, right? Because the industry deposit growth is at 14%. So on the branch level, when do you think we will see ahead of industry deposit growth?
If you think in terms of vintage, we've just been 5 years. I reminded you earlier that our deposit in 2018 was 10,000 crores, which is, think of it like a starting. So in that sense, we are new, okay? We are not like, So, but our deposit per branch is already running at 200 crores, just for information, Gao. 200 crores per branch today. So there is something very strong about the way we have built the capabilities of our employees. Of course, a lot of it has got to do with the digital, some has got to do with the culture. We're like crazy about customer service. We really get pretty, we take that. So I think got culture, service, tech, all that is coming along. So I'd say that we are now in terms of, we don't want to only depend on branches because we feel that's not efficient. In tech, you invest once, you can multiply it minimum, you can give far better returns than invest in branches. So our incremental going in thesis in the next 5 years is that we don't need as many branches. We just don't need as many branches. We feel that our current tech is firing very well. So as many branches meaning that, to grow to our current deposit base of say 2 lakh crores, we needed say 950 branches. It doesn't mean to take the business to say 4 lakh crores, we need 1,800 branches, and to take to 6 lakh crores, we need 2,700 crore branches. Not like that. It's not needed anymore. For example, when we take our book from say currently 2 lakh crores to 6 lakh crores, we don't expect to add more, not more than maybe 5, 6, maybe 700 branches more or 600 more. But it's not 2,700 more. So the incremental throughput per branch for the bank is very good. What we're saying is that deposits will grow disproportionately more than the number of branches we will add. That we are very clear about.
Got it. That's good to hear and very clear. And do you mind, in your FY25, your next 5-year guidance, do you mind sharing with us what kind of assumption are we assuming in terms of per branch deposit growth? Because I guess that affects our cost assumption as well, right? So just want to understand a bit more on that.
See, we have said, to be very specific, we have said that currently we have 900. We said we will get to 1,800 branches. That is 2x. That is 900 more for 4 lakh crores of deposits. Today we are 2 lakh crore. We're going to say we're going to add 4 lakh crore of deposits by adding just 900 crores more. So which means that our branch productivity is going to double on our incremental branches. That's briefly the way we're thinking about it. Frankly, we feel internally we are feeling very confident about this. There is in our senior management, if you were a fly on the wall, if you just walk across any branch and talk to, I really invite you, please, many of you on this branch, please walk across any of our branch, talk to any of our branches and staff, befriend somebody whom we want to know, and talk to them how the bank is doing. They will tell you how the bank is doing. The feeling is very, very nice within the bank. Got
it, sir. And last one is on the credit cost. How how should we think about the credit cost going forward? Obviously, we are kind of normalizing back slowly, right, from a very depressed level similar to the industry. So do you think this process continues slowly in the next year, or how should we think about this year?
See, credit cost is a direct benchmark of what happens, that the input parameters that flow into that become a credit cost, like how the check bounces are, collection efficiency, etc., that lead to it. Now, we are finding very stable performance on our books. We feel that our credit cost for the next year could be, currently is about 1.3. As it normalizes, we expect about 1.65 or so next year. But it'll be more, it's likely to be more, front-ended for a reason I'll describe later if we have time. But we feel Q3, Q4 credit cost we expect to be quite low. And think of it like almost like a flat line all through the next year. But think of it like a 1.65% next year.
Got it. And our fourth quarter credit cost per your calculations is one level, sir?
Didn't get that question, sorry.
Sorry, for the fourth quarter, what's the credit cost per your calculation? Per your definition, what's the fourth quarter credit cost? For the full year is 1.3. Just wondering for the fourth quarter, what's that?
So your question was, what was it for the quarter? It is 1.5% for the quarter. And next year we're guiding for 1.65%. Actually, we feel internally more like 1.6, but think of it like 1.65. So 1.5 for the quarter.
Got it, sir.
But what is, I just want to just flag 1 second. What we feel very, at least good about us within this, is that it's not that our yield of the book is high or NIM is high. The fact that we're able to do that with low credit cost is a very unique capability. We really believe that. So, but your specific question on guidance, I've told you now.
Got it. Thank you so much.
Thank you.
Thank you. The next question is from the line of Deepak Vora from Premier Capital. Please go ahead.
Yeah. So good evening all. I really thank you for the opportunity. And first of all, congratulations on the result. My question is largely on the cost to income ratio again. Although, we have come down from the levels 5 years ago, but I feel that we are still at a much higher level than the guidance shared during the merger, which was around 55%. Also, if you see the financial year 24 versus 23, on an annual basis, the cost to income has actually gone up rather than scaling down. And in the last year, we have made a significant investment for the BCCI sponsorship. So I just wanted to get a better understanding on what drove the high levels for financial year 24.
Yeah, so if you see, cost to income has been, we agree that it has been stable during the current year. It has not improved that significantly. But if you see, in the previous year to that, we had an improvement of about 500 basis points. As Vaidya said that we expect cost to income to meaningfully come down starting H2 because of legacy liabilities sort of coming off, because of credit card moving towards profitability and many other factors. So we know this is a one key deliverable for us, and we expect to better on this front as we move along.
Thank you. Thank you very much.
Thank you.
We have want to flag one more point to you. Everything we're building in the bank, I understand many of you are concerned about the cost at the bank. That's right. The thing is that trend line is good. Of course, this year we didn't do a good job in the sense it just flattened out. Interest rates went up, and that kind of skewed a little into the margin. Otherwise, we could have done better. But still, having said that, let me just say that everything we're building in the bank, we're thinking long. And this is super important to note. For example, there was no pressure for us to have launched credit cards. Well, we could have lived without credit cards and life would have been okay. But then, we would have paid a price when we woke up in 2025, 26, 27, 28, when we would have started to launch the credit card business. We'd have to come back and be defensive, or, the numbers would be going the other way around when it's supposed to be improving. So we just launched so many lines of businesses, whether it is gold loans, whether it was, Kisan credit card. We launched a prime home loans. which is also, by the way, a drag on the bank at this point of time. Is not making any money. It is just because that's the way the long-term nature of these products are. For example, with a home loan, you book all the DSA payouts and cost evaluation, everything upfront today. The money will come when it comes over the life of the contract. So, but we are not holding back. We are building what we have to build, because otherwise the future will be difficult for us. So prime home loans we started, credit cards I give the example, then education loans we started. These are commercial vehicles. We want to meet a PSL requirements. They are all negative products today. They are not making any money. In fact, they're negative. We started cash management business, a lot of technology build that goes into it. We started trade finance solutions. We started a lot of builds for that. Forex solutions are building, negative drag on that. Gold loans we started, negative drag on that, losing money as of today, but it will not lose money forever, but it's just a build-up stage. We have 1,000 crores. So KCC, I told you, farmer loans, tractor loans, wealth management, FASTag, Forex card, you can name the list of products we're launching one after the other inside the bank. They all lose money initially because everything needs a scale of time. So that's why we are confident that once they all start gaining, momentum and they come out to the J curve, then you wake up in 26, 27, 20, 29, they'll all be throwing back cash.
Perfect. Thanks a lot.
Thank you. The next question is from the line of Prakhar Sharma from Jefferies. Please go ahead.
Hi, Vidya and team. Congratulations on the performance. I just want to ask you on a couple of things. One, could you, give some sense of, the loan growth expectation, let's say how you're building up for the next year? And, as the operating efficiencies start to play out, maybe credit costs start to normalize at a slightly higher level, in a 3-year view, what should we think of ROE terms? Thank you.
Yes, so Prakhar, maybe I'll answer that question. So loan growth has been 25% in this quarter. If you see, in fact, on a quarter-on-quarter, the growth is 6%, and within that also in certain segments we have slowed down, like consumer loans have slightly come off, even digital loans has not grown in that proportion. So we feel that loan growth would be more around 22 to 23% into the next year. Moving on to the credit cost, as Raja guided, we should range around 1.65%. And certainly our endeavor on ROA would be to touch more closer to, I would say, 1.45, 1.5% in next 2 to 3 years.
So, and Prakhar, by the way, thank you for your research report on us. It's so detailed and in-depth. Wow. It's a great job. So thanks so much. Not because you said good things about our share price, but just the quality of the report is something that we're super impressed with. Prakhar.
Thank you. Thank you. Best of luck.
Thanks.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah. Hi, good evening, and congratulations on a strong performance. And really, the deposit progression is nothing less than outstanding, sir. So, hearty congrats on that.
Thank you.
So I have 2 questions, sir. Like, first is on the LAP portfolio growth. So after a gap of 4-5 quarters, we have seen a double-digit growth in the LAP portfolio. So how are we looking at this? Has there been an improvement in the credit environment? And this used to be one of the main businesses, and now seeing this traction this quarter. So anything more to read into this? And second is on the liquidity coverage ratio. Because while the deposit growth has been very strong, but still there has been a slight drop in the LCR on a sequential basis. So what has really caused that?
Let's take one by one. See, LAP, frankly, whether it's LAP or any other business, it's just in our hands. We can book as much as we want. This is we are a small player. We have fantastic tech capabilities on being able to originate loans with good asset quality. So, well, if you need to do more, we don't have to relax any credit norm. We just have to open some more locations and we are in. So really, currently LAP is growing 20, but we are moderating more with the amount we want to grow, keeping the amount of capital in mind. We should be, thinking of raising capital now. So we want to make our capital run longer. So we are more conscious about how much we want to grow the balance sheet because in a given year. And that's why we guide for this 22%, which Sudhanshu said. So the short point is therefore that we don't have any problem. You don't have to worry about growth for our side. It's in our hands in that sense. With quality, not to worry. Now, LCR, frankly, it's marginal. I don't think there's any specific, if you keep growing the way we're growing deposits, we are very clear the next year deposits also will grow. We'll keep our LCR, certainly no higher than 80%. Don't you?
No. LCR.
No, not LCR. I mean the CD ratio.
CD, yeah.
But CD ratio next year, for example?
Yeah, should be around 75 to 80%.
Should be 75. So we are so confident, Nitin, that on a deposit story, that next year also, I mean, by the way, it's been 5 years going, our CD ratio, our incremental CD ratio is really very good. And we believe even next year we can keep it, under 80%. And on LCR maybe.
Yeah. So Nitin, on LCR, we would continue to maintain around 115% levels. And so we feel quite comfortable. We don't see it as a challenge.
So 115, 120, somewhere in that zone will always be there.
Yeah. So some liquidity got deployed during the current quarter, but we feel quite comfortable.
Okay, sure. Thank you so much.
Yeah, nothing to worry.
Yeah, thanks.
Right. Thank you.
Thank you. The next question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Thank you, sir. So just continuing from the previous question on LCR. Sir, on the previous 4 quarters, if you look at LCR has been more than 120%, but in this quarter for 4Q, annual average we are giving 114. So is there some reclassification of deposits that's happened? That is what I wanted to understand. That is one. Second, sir, thanks for the elaborate discussion on the rural business that we are building. So if you could just help us understand what will be the rural ROE that we are making right now. And second, if you look at the last 5 years, it has been good from a monsoon's perspective. So in case the macro turns adverse in that, are we building in some safeguard buffers on that portfolio, or what could we thought around that?
Why don't you take the LCR question? I'll come to the rest.
Yeah. So as I mentioned to Nitin, that of course we were maintaining slightly higher LCR into the previous quarter. This quarter we have come down to about 114% on an average. One is we did not want it to play the rate game. It's quite intensive, as you know, right, in the last quarter. So we feel that even into the future quarters, we should be able to maintain LCR comfortably around 115%. So it's more, I would say, a quarter phenomena where slightly some normalization has happened, but we feel quite comfortable on that.
Like we answered the previous speaker, Nitin, this is like business as usual. There is like lots of liquidity. In fact, if you do a smell check in the market, and I really request you to do that, you find out, will you ever find a bank ever in any corporate fighting for deposits in a large corporate? And there are a lot of, these names that go around during year end. Somebody wanted to pay 500 crores, 800 crores, 1,000 crores. We just genuinely say thank you to them, saying that, look, we're just not there in this. We just don't need it. And that's because our retail flow is so strong, that from the branches and everywhere, so strong, we just don't need it. So I assure you, please check. There is nobody will ever tell you that our bank is out in the market for the bulk deposits. It's not there. So coming back to the point, so therefore we're good. Now on the rural front,
follow up on that, because investment is also gone up by almost 19% Q on Q. So that should have typically prompted an uptick in LCR. The liquidity has actually increased. So that's where there was some confusion.
No, but we clarified that. No, that currently it's a lot of liquidity. Think of the 1-2% here or there. It's not. Let me just say it's not material amount. Okay. Now let's come back to the rural question. Now, the rural economy. See, it's not about rural economy, urban economy. I think people just kind of give stamps and tags like these. We don't like these kind of classifications. They are not. This is not one homogeneous rural market and a homogeneous urban market. ऐसा कुछ नहीं होता है. So the thing is that within rural market, there are just so many markets. For example, if you're giving a home loan, a loan against property, or you're doing a good cash flow assess models, then they all have their, then they perform well. And you have to treat them over cycles. And we have seen, 14 years. Let me tell you what is 14 years, so that you just you get to appreciate that better. Every loan, every month is a cohort to track over a life cycle. 14 years means just think about it. That's the number of cycles we have gone through, not just 14 years cycles. Every year within that 14 years is a cycle. So we've been through just so many cycles. We understand this economy very, very deeply, whether it is a rural housing or a rural home loan or urban home loan or urban rural market or micro enterprise loans. Our JLG business was happening even before the merger happened. Merger happened in 2018, but my predecessor, Dr. Rajiv Lal, thankfully had acquired a JLG company called, I think, Grama Vidyal, and that turned out to be a phenomenal company for us. And I often thank him, heart of hearts, man. Thank God he gave me good franchise there. So we've been tracking this very, very closely. So the main thing is systems and domain knowledge. Systems and domain knowledge. Systems are systems. There's no substitute for good systems, but good systems plus domain knowledge. Don't worry. I mean, if there's anything to call out, we'll call it out also. We will be totally honest, transparent. As you know, you've been with us for many years. Hopefully many of you are. We've never hidden problems. If there's an odd issue somewhere here, then we'll point it out. Nothing as of now.
Sure. Thanks.
Thank you. The next question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. Hi, sir. So this entire breakup in terms of the cost to income, if you can highlight in terms of the proportion, how much would be getting into the credit cards and the liability of the total cost of 60,000 crores, just trying to see in terms of how much of leverage can it bring about in terms of the overall cost to income as and when it normalizes.
I don't know the number offhand.
Kunal, we're not calling out that number, but when we are talking about credit cards, we certainly see the trajectory improving there. And on liabilities also, why we saw some uptick during the year because we have put out more branches and so on. But we expect to sort of improve on these numbers. Our incomes from insurance, selling of third-party business are improving. We have still some ground to cover there. So I feel that with a combination of better cross-sell, distribution of asset products from branches, insurance products and so on, we should continue to get an uptick on the fee income, as well as our costs should normalize on the liability front into the next year.
And Kunal, let me add one more point to you and thank you to everyone hearing this call. See, we talked of a long-term picture, like 5-8 years. We said, look, India will grow like that, and we believe we will do well in that for the reasons I described earlier. But let me just give you a short-term view, like a 1-year view, so that you know what to expect from us. Now, what our view is that the next couple of quarters we should expect, maybe next quarter, you should expect flattish kind of performance from us on a earnings front, or somewhere in the zone. And maybe, Q2 should see some improvement, but Q3 should see good improvement, and Q4 should see strong improvement. So it's going to be very back-ended this year, and I'll describe that reason also to you, and if you understand the reason, then you feel comfortable. So that's why I mean to give you a short-term guidance. Now, it goes like this, that, in the first quarter, of course, we'll get salary increments and all that stuff, which of course happens to everybody. Then second thing is that, but it does cause a temporary, slight touchdown to the numbers. The second thing, but more important, I called out last time, but I'll say it again to you, about FLDG. So we are a good players in the digital market, and there are certain partners with which to do business. Now, we were earlier in a model whereby when we did a digital loan, the full income, maybe 17-18% came to us, and the full credit cost came to us because there was no FLDG. Now, recently, the FLDG is permitted. Now, what did we do? It is a good thing in the interest of the bank in the longer run to move to a model where the partner absorbs the credit cost. But it works both ways, so that the partner wants the income today. So what we are doing is that this quarter onwards, that happened as well as the quarter that will come up in the next 2 quarters, you will see us pay out to that partner. But, so therefore our OPEX will go up in Q1. But what will happen is that when Q3, Q4, these are by the short-term loans, 6-month loans kind of stuff. So when Q3, Q4, when the credit cost will come on those loans, that credit cost will be incurred by the partner, not by us. Therefore, you will see that there will be so the credit cost in Q3, Q4 will be quite low and benign, and you will suddenly see a PAT shooting up in that time or going up in that time. Is probably a better word. And Q1 you will see our cost because they're going to pay the partner is going. So this is one reason this FLDG.